Good morning, Mish. How you doing? Are you can you calm us down a little bit?
Well, I guess the best way to calm you down is that there were signs. Obviously, Dennis mentioned the regional banks. That's always a sign. But even more than that, coming into today, after the initial earnings that we had this week, with starting with Microsoft, I thought the market's reaction, except for those individual stocks, and even those weren't all that amazing, kind of gave us an idea that, first of all, we have to remember that earnings are also lagging indicators. It's what happened, not necessarily projecting what will happen. And of course, with Meta, they're talking about this great future that remains to be seen. But in the overall market, I thought the reaction was relatively muted even before the Fed. And then after the Fed, we had that one pop. So if you looked at certain things, we know small caps, right? Grandpa, we talk about this all the time, hasn't been able to get through. If you're looking at IWM, that 200 level. Retail, also super important after the strong consumer that we kept hearing about coming into the end of 2023, at the beginning of 2024. Well, really, it's basically been range bound, hasn't really gone very much, except some individual stocks have done well. And then if you look at even the SPY from the peak a couple of days ago with the gap down yesterday, it left kind of a weird topping pattern that could spell a correction coming from about 5-10%. So I mean that's the way you have to look at it. As Dennis said, or I think it was Dennis, you have that sort of mixed feelings as an investor. You want to see people working, but you are counting on the Fed to lower rates. And I think that's really been the dangerous
It
thing in
has
the
been.
market right now is that when the economy is doing well, we have to get used to a level of normalization. And if that happens, it'll be actually good for the market after things sort of rotate and settle down. That's, of course, given there's no major default in the banking system. And that's also given that companies that have been able to tolerate interest rates for at least this long can continue to tolerate these interest rates, like you're saying with the banks. So, at this point right now, I don't think it's the worst thing in the world, but I think we were getting lofty in anticipation and reality setting in.
We talk about turns in the market, right? And so there's, we're still up 11 and a half handles. We're acting like the sky's falling here, but a long-term sustainable trend here. Is this a turn? I mean, do you think that this is going to make investors reevaluate, where they're pinning interest rates? We had what some people saying 6 cuts this year. Also, what's the impact of this, of this job growth, right? Instead of a decline going to have on the inflation numbers coming up. People are out there, they're working, they're spending money. What is this a major turn or is just a little blip in the radar?
Well, I think it might be a rotation actually. So if let's say the perfect scenario is that the Fed obviously won't cut, but they don't have to raise because inflation doesn't go out of control. And what will spiral? Inflation would not necessarily be consumer spending. Of course, we can see what could spiral inflation. It would be government spending, the debt that we still have. Obviously, what's going on in the Middle East has been such a relatively muted reaction to the market so far, but you never know what happens there. These are the kinds of things that the Fed are watching. And so if that doesn't necessarily come to pass, and inflation stays even around, if we're looking at CPI, this 3.5, 3.4, 3.5%, and the Fed funds rate can stay, relatively where they are, then what we will have is, I think, a rotation. I mean, obviously, growth stocks are in their own universe. But in terms of the rest of the market, we may really get to see what is actually real as far as what people are earning, spending. And that's why you have to watch the Modern Family. I mean, it's been so reliable. You have to watch those small caps. If they hold up, the market will hold up. If retail holds up, the market will hold up. If transportation holds up, the market holds up. If they can't make it, if we start to see numbers come down below 1900 in IWM, or if we start to see retail dropping below XRT 68, or even IYT below, let's say, 255, it's trading at around 260 right now, then we know that the economy can't handle this and the Fed will have to do something. So
And
I think it's a waiting game right now.
IWM actually, I would argue it's holding up fairly well, considering what's happened with the carry in the last couple of days. If you would have told me the carry was going to fall 15% 2 days, I'd say the IWM is hammered. IWM in the last 2 days barely down. So I mean,
Yeah.
so far, I would say actually so good. Like technicians maybe argue it's failed at 200, and this is the eventual, like this is going to bring the markets down. The bears are arguing that all over my Twitter feed, but it's been pretty bloody resilient considering that the KRE has really been hammered, and there's a lot of banks and there's a lot of small companies in the IWM that depend on lending. So, higher rates for longer is not good for any of these companies, but I'd argue the IWM's holding up not bad.
Well, yeah, absolutely. And there is some expectation. There were people expecting this coming into the year, but it hasn't happened yet, but it could still happen. Is more of a rotation into value and small caps, excuse me, and staples over discretionary. And maybe we'll still get that. And maybe that's the sign that we're seeing right here is if it can hold up even in the face of KRE, what does that mean? Maybe things are healthier. I'm sorry.
My cough is contagious here, Mish.
Well, maybe things are healthier than people like to believe. I mean, obviously, the narrative politically with an election year is that the economy is doing horribly. But in reality, there are areas and pockets, of course. But right, things are not as bad as one would think yet. I mean, of course, everything can change. The
Yeah.
other very interesting thing was, we like to use risk gauges, and a lot of the risk gauges are dependent on how the long bonds are doing versus the SPY and versus the junk bonds. And they flipped to risk off a couple of days ago. So that also kind of told me that these are not right here the buy opportunities that one would think that we had, let's say, a couple of months ago. And so, yeah, I mean, I think that if you really track right now, not necessarily what's happening in the growth stocks, because, like I said, that's another universe, but what's happening in the thickness of the market right here. And you really see right now what the impact of the jobs, the higher for longer. The dollar's been softer, but the inflation numbers that haven't been all that hot, oil's come back down. And you can start to feel those IWMs, particularly the small caps and retail, hold up. You may see a different type of rally as we go into February, March, April, before the Fed has to do anything. And maybe the Fed, 5.5% is not horrible if you look historically.
No, it's like historically normal interest rates. And I remember when we first started raising rates above 3-4%, people were freaking out, and I was like, wait a second. I mean, if you're a company that can't survive 4% interest rates, then what are you doing? Because historically that's just normal. Right now the market you mentioned, Mish, has been is kind of tentative going into Microsoft's earnings. It seems like there's this uncertainty, and I think the fear right now is that the Fed won't be able to cut rates like it was anticipated going into the year, that there was going to be 5 or 6 rate cuts or whatever. But do you think that fear changes at some point now to that they might raise again, or are we just at most going to stay where we're at for longer?
Well, if you listen to Powell, I think he's really pushing for keeping things in an equilibrium right now. That's really basically what he's saying. I mean, and let's think about it realistically. If they have to drop the rates, especially as people were looking 5, 6 cuts, that's very recessionary looking. And we don't want a recession. So right now, that's why I said the market hasn't seen. I mean, I can't even believe myself saying it because I tend to also be somewhat of a contrarian. But what I'm seeing right now is this normalization is healthy after people adjust their mindset to what that means. And you're right, some companies will not make it, but other companies will. But think about why they were in business for so many years, because they had very low interest rates and they had very low taxes. They could borrow basically for nothing and pay nothing. So they were growing basically on vapor and not on reality. So if we have a reset of reality, is that the worst thing? Provided, of course, there's no little crisis that happens, like I said, geopolitically being probably the biggest threat.
Is there pockets like that you favor if we're going to be higher for longer? Are there pockets and stocks that you favor in that environment?
Well, yes. And in fact, let's look at the consumer, because a couple of things you just said are so interesting to me. And that is that even here in the United States, I think there's a shift from let's travel, let's go out to eat. And I started out this year, I coined the phrase vanity trade for the consumer, where people go from it was all about we to all about me. And I think the diet drugs really have been maybe the catalyst to all of this, because if you think about the trickle effect of people now more and more, and look at the stocks that are involved with that, like, Novo came in great. And some of the medical stocks that are having to deal with diet drugs are also doing really well. So if you look at what happens with the consumer, they're not necessarily concerned about the cost uh, as far as getting themselves to look better or feel better. So that's why we're liking things like skincare and beauty and fashion. And how does that overlay into also working out more and taking better care of themselves? So I'm starting to look at those kind of stocks. Some of them have done very well. AbbVie was my top pick. That thing has just been flying.
Yeah,
I think you look right now at the stocks that are reflective of how people want to take care of themselves better, which is another good trend, by the way. And then on top of that, you can eliminate the stocks that have poor balance sheets because of exactly what we've just been talking about. They can't handle the interest rates higher for longer, and start looking at some of the small cap companies in particular that have good balance sheets and can survive this and are actually growing on their own. And I think if you look at it with that kind of magnifying glass, it makes the environment tougher for the people who could just throw a dart and buy anything and everything went up. But it doesn't mean that there isn't any opportunity until we see a major reset. And at some point that will happen. But yeah, it's definitely an interesting environment right now, for sure.
Mish, before we let you go, we haven't covered yet earnings out of oil, the big oil companies. I mean, you've gotten some pops in oil up 76, 77. I don't know if it hit 78, but these stocks are not responding. Is this something that you're looking at? Is just, hey, if it hasn't gone yet in this kind of market with crude, it's not going? Or where you stand on crude and also the big oil stocks?
Well, I haven't really touched the big oil stocks in a while. And so I can't really say that I would recommend buying a Chevron or, Occidental, even though we know Buffett still owns a lot of that. So I've really been watching the futures market, because people, ask me about pricing power, like, why, if you like miners, gold miners, shouldn't we buy Newmont? Well, obviously the companies don't necessarily reflect the pure future, the raw material. So if we're looking at the raw material here of oil, there are some people who think that the prices are being held back before the weekend when things can explode in the Middle East. I mean, that's obviously somewhat of a conspiracy theory, but if you're just looking at the oil right now, it's doing exactly what we kind of expect, which is chopping around in a range between, say, $65 a barrel, which we haven't seen in a while,
Yep.
and $80 a barrel, which we kind of almost teased looking at WTI, but couldn't get through. And now we're back at what, around 72 and a half, $73 a barrel. So we're at the lower regions. So I can't get bearish and say it's over, but I can't get overly bullish until we start to see those numbers clear that $80. And then we will know what that impact will be on everything we just talked about. This just great environment that inflation right now is kind of not at 2%, which I also think is unreasonable. And I still believe the Fed at some point, if they see things stabilizing, may say, well, maybe 2%. Maybe we're looking at 3% now, because you can't have a growing economy and a 2% inflation. Makes no sense. Look at oil. I mean, that's going to be your X factor. And right now, there's no concern, even with everything going on, like I said, unless we take out $80 a barrel. And then maybe those oil companies will look more appealing. But right now, I'm much more focused on the actual raw material.
All right, we've been on the line with Mish Schneider, running Market Gauge, giving us fundamental, technical look at the markets. Mish, always a pleasure having you on this busy job days. Thanks for joining us.
Thank you so much for having me.
thanks, Mish.